Imagine two investments. Portfolio A returns 10% for the year, and Portfolio B returns 12%. If asked which performed better, your instinct immediately points to Portfolio B. In institutional finance, however, judging success solely by that top-line number is a severe miscalculation. Measuring how well money is managed requires uncovering the invisible forces used to generate those returns, specifically the exact amount of risk taken to reach them. We evaluate this through a three-part framework, a matrix consisting of mathematical risk, strategic execution, and human bias. Without calculating these hidden dimensions, an investor is effectively flying blind, unaware of the actual vulnerabilities lurking beneath their profits. The first lens establishes a strict mathematical baseline using modern portfolio theory, or MPT. This chart shows the efficient frontier curve, mapping out the maximum return for any specific level of risk. The area below the curve represents inefficiency. A portfolio sitting here takes on too much volatility for the return it delivers. To predict those exact expected returns, we use the Capital Asset Pricing Model, or CAPM. A key input here is beta. Beta measures systematic risk, specifically how a stock's volatility compares to the overall market. Looking at this security market line graph, CAPM combines the risk-free rate, the market premium, and beta to draw a required baseline return. If a portfolio fails to clear that specific hurdle, the investment is objectively a failure, regardless of its raw percentage gain. The second lens evaluates strategic execution. This depends on how efficiently the market prices assets. The efficient market hypothesis argues that asset prices instantaneously absorb and reflect all available information, both public and private. If that theory holds, performance is simply measured by how perfectly a passive fund mimics a broad market index. Success means minimizing tracking error. Active management takes the opposite view, believing markets are messy, investors overreact, and pricing anomalies are constantly left behind to be exploited. This investment clock describes one common active approach, rotating investments through different sectors based on the economic cycle to beat the market baseline. This requires taking on active risk, a deliberate deviation from the benchmark to chase excess return. Performance in this lens evaluates whether a manager successfully weaponized those market flaws or merely took on unnecessary risk to end up tracking the average. Those previous models assume all investors act perfectly rationally. The third lens brings in human reality. Behavioral finance recognizes that our decisions are constantly corrupted by bounded rationality and mental shortcuts, known as heuristics. Prospect theory shows we value gains and losses on vastly different emotional scales. We are wired for loss aversion. Kahneman and Tversky found a loss is felt 2.25 times more painfully, causing investors to irrationally sell winners early to lock in a profit. This table of key concepts highlights other traps. People anchor their decisions to past purchase prices, or follow the herd by trading on emotional noise instead of fundamental data. Ultimate performance measurement must evaluate how effectively a portfolio manager insulated their strategy from their own irrational human panic and cognitive bias. Modern portfolio management has evolved to bridge the gap between strict passive efficiency and aggressive active risk. We now see hybrid models like Smart Beta, which track fundamental characteristics like volatility or momentum instead of simple market capitalization. The definition of performance has also expanded into ESG and impact investing, where targets incorporate specific environmental and social objectives alongside financial returns. Institutions are increasingly measured against global disclosure frameworks, evaluating everything from climate impact to corporate governance. Look back at our opening scenario, Portfolio A returning 10% and Portfolio B returning 12%. True performance is the final product of efficiently priced risk, exploited market anomalies, controlled psychology, and alignment with ultimate real-world objectives.